Is there a certain net worth or at what level would this be a beneficial plan? I mean, my kid's Pokemon card collection it probably won't generate a whole lot of, well, it won't generate a big tax event. So I don't think that we'll need to use a DST for this. Uh, so what you're talking millions in bitcoins or personal homes, that kind of thing. Is there a like a I guess a minimum entry level that
Yeah,
this would
one
be
million net
worthwhile?
proceeds, $1 million gain is what we found to make sense. Unless you have two at 500 each. So if you had two exits, like a $500,000 Bitcoin exit and a $500,000 real estate exit that combined basically had over $1 million net proceeds and about $1 million gain combined, then we can make that exception. But anything smaller than that doesn't make a lot of sense. If you're selling a primary home, you have what's called the 121 exclusion, which gives you 500,000 tax free on if you're married, 250 if you're single. And so in that scenario, we like to see about a $2 million net proceeds, $2 million gain, right, to make up for that, to make sense. But we did an $8 million Palo Alto primary home exit for a seller. It was a tremendous exit for him. All of his kids had moved out of the house. He had 6 kids. One more than me, which I always scratch my head when people have just one more. I'm like, wow, how'd you do that one? So we have 5, but yeah, he had 6 kids. Kids are all gone, and all of his wealth is tied to this primary home that's gone way through the roof. He also had this big debt on it that was, kind of overwhelming. And so we were to sell, get debt free, take his equity, and then he moved to Nevada, which is powerful because once you're in a new tax state, the income tax is on that scenario is 0 versus California, which is higher. And so he's able to receive payments from the trust once he established residency in Nevada at a lower tax rate, which was huge for him, which is part of how we show people how to make the DST an investment and not an expense. The joint venture partnership, the tax efficiency by if you move to another state, deferring the income tax and not taking the full interest payment, resetting depreciation schedules when you partner with the trust. These are all the insider parts that we we help people with. So to answer your question, if you have it's got to be big enough, right? And obviously, if you're in New York, New Jersey, Illinois, California, you got Minnesota's a big one. These are larger tax liability states. It's even more valuable, but any state, no matter what, if you have $1 million net proceeds, $1 million gain, you don't need to spend it like on your primary home. We found it to be a home run.
Does it matter where the trust is established? You're talking about California versus Nevada.
Yeah. So our company, we've got 2 offices in Nevada and Florida, and so those that does matter. It does have some difference in that. And so when you're in the lower tax states, it helps at the trust level for sure. Although typically the trust is not paying any tax in any given year because it can expense the interest on the note on paper and for its tax return. As far as the seller, though, the nexus will stay with where they're at. So if they sold in California, the principal, if and when they dip into principal, they'll pay cap gains back to California and to the federal government. But a lot of our clients are just living off the interest payments, right? So we did a 7.9 million sale out of Santa Cruz. It was like a beach Airbnb property, and we deferred all the tax, and they just have been living off the interest payments. Right. And so that's what most of our clients do. And at the end of the 10-year term, they can take the full balloon payment. They can also renew it for 10 years, which is like what they're going to do, and just keep doing that. And then the kids can step into their shoes. And so that's really the concept that we work with folks. Like most of them just want to be able to live off of all of the interest or partial interest and let the other, extra, in this scenario, I think it was an extra 40% more proceeds, right, that they have working for them versus, had they sold and not done any planning and just paid the tax. So those are all the things that we work with people, Aaron, to make sense of it.
Mm-hmm. Is there any complications with, say, investing in syndications or securities like that?
0. In fact, those are our favorites for our clients. We work with some of the best in the country, DLP Capital, Ashcroft Capital, Praxis
Mm-hmm.
Capital, Brian Burke, Don Winter, Joe Fairless, some of you know, Dan Hanford, Kevin Bupp for Mobile Home Parks, and Yeah, so we work with groups all across the country, and then also individual syndications as well, for clients. So it's beautiful. Like it can go right into these assets without having to do any kind of 1031, gymnastics.